quickly as we can. All right, so now we're just going to talk about some of the fundamentals to this whole thing, and I just want to give you some underpinning knowledge which you're going to apply to this booklet in a minute. Accounting systems, like every other system, very basic. There's an input, there's a process, and there's an output. So not too hard. That accounting system is broken down into a process that involves this, that when we have a financial transaction, we make a sale, we buy something, we get something on account or whatever. Some sort of financial transaction takes place. We go looking for a source document. Where's the source document that created that? We then record that in a journal, which is just recording in date and time order. As it's happening, that's what a journal is. Just like a journal in your diary. Journal's like a diary where you just record things as it happens. That's what a journal is. But it's a lot of information, but it's not meaningful. To make it meaningful, we need to break up that journal and put everything in the proper account. So all the things to do with rent, we put in a rent account. All the things to do with sales, we put in a sales account. Everything to do with wages, we put in a wages account. That's called posting to the ledgers. So we take the information that's in the journals and we post it, or if you like, we transfer it to the ledgers. And the ledgers are all these little boxes, assets and liabilities and all sorts of things. And we take the stuff from the journals and we put it into the little boxes. Once we've got those boxes, we do a trial balance. And the trial balance just makes sure that all of our debits equal all of our credits. Because under the double entry bookkeeping system, every time we record the transaction, there should have been a debit and a credit of equal value. Remember, when I lend you $100, you don't owe me 90, you owe me 100, believe me. So there is always the debit and the credit, or the yin-yang, if you want, of every financial transaction. There's an equal. Both sides are exactly equal. And the trial balance just does that. It just adds up all the debits and credits and says, if every transaction was a debit and credit of equal value, at the end of the year we should be able to add the two columns up and it should equal. Then we know at least everything's been recorded properly. Once we know it's recorded properly, we prepare an income statement. An income statement tells us how profitable we've been, how sustainable our business is. And we transfer then the money that we make on the income statement, because the money that we make is owed to the owners, and it goes into the owners section of the balance sheet. And the balance sheet is simply a summary of the financial position of your business. It tells you what assets you've got, tells you what money you owe people, and it tells you what money is owed to you as the owner. If you sold everything, paid everything off, this is how much you'd have left. So balance sheet is the final report of all the financial systems, or the accounting system. So that's a process. You're obviously going to be asked that in your workbook. So you don't need to take notes, and I have got a copy of the PowerPoint for each table, so that's going to help you. Source documents, let's cover them quickly. Source documents are critical. Remember, for audit purposes, for accounting purposes, they're critical. Every time you enter something in the book, it's supposed to be objective, which means you've got to have a source document that identifies how the thing was created, the transaction was created, and it's also important for tax point of view. A tax point of view and an audit point of view, they need to drill all the way back. They need to go the reverse of that system. You produce your balance sheet, they look at your balance sheet and trace it all the way back, and they say, where's the source document that created this transaction? And they want to go from your report all the way back to a source document. So your source documents need to be ordered in a particular way, and we can cover that. Can't cover it in this course, but we might be able to cover it in a Saturday workshop very soon. We use the source documents to put the data in. There's a source document for every transaction. In accounting and in tax law, there's a source document for everything. Types can be cash receipts, payment advice, check butts, supplier invoices, bank statements, authorised memos from the accountant. But there's a source document for every transaction that goes in. Remember we said it goes from the journal. Yeah, answer or stretching?
No, I wanted to ask the question. How long do you have to keep all those source documents?
5 years. Okay. From date, 5 years from date of lodgement. So if you were 3 years late in putting your tax return in, you've got not only those 3 years, but another 5 years from the date of lodgement. Remember I said journal is just recording things as they happen, and then we put things into boxes? Those boxes are grouped into 5 main areas. There's 5 main groups that we put them in. We say, is this an asset? Is this a liability? Is it an equity? Is it a revenue? Is it an expense? Basically, everything in accounting fits into one of those boxes or box groups. Just to explain what they all are, an asset is an item of economic value that has future benefit for the firm. It's an expense in accounting terms is that money that's been used up to earn the revenue.
Okay.
Now, an expense might still be a liability because it might be money that we still owe. So it gets recorded as an expense, but then it might become an accounts payable, which means it moves into a liability.
Yeah.
But that's a different transaction when it does that. If you just paid it for cash, it would just go straight out of the system through the expense option. So this is where it's actually expense, and this is where it might have been expense, but it still hasn't been paid. They actually belong to different. Yeah, they actually belong to different reports. The revenue expense belongs to profit and loss, as we're about to see. Assets, liability, and equity belongs to our balance sheet, and I'll show you that in a minute. When we're talking about profit, all we look at in profit is what did we earn in revenue, and I like the word revenue as opposed to income, because income is more at that end of the scale. What we got in revenue, sales, if you like. What were the expenses incurred in earning that revenue? And the difference between that creates a profit, and that profit is owed to the owners. When the business makes a profit, the profit is owed to the owners, and that's you. Well, if you're the owner. Remember I said when we're going from the journal to the ledger, we create a whole lot of boxes. Those boxes are broken down into, and I said 5 groups, and now I'm going to introduce a few more groups, but there are subgroups of the main groups. Those 5 that I've told you about are the 5 groups, but we do have subgroups that help us with our reporting and our budgeting and our making the information more meaningful. And to create these, we have to come up with numbers, because the numbers help us to classify things a lot easier. But we don't want to have numbers all over the place. So we basically allocate 1,000 to 1,999 to assets. So all of our accounts that we put in assets, the chairs we're going to put as 1,000, the tables we're going to put as 1,001, carpet we'll put as 1,002. So we actually go through and we give an account number for each of the assets, or each of the liabilities, or each of the income, and so forth. And we usually break it up. This is called a chart of accounts, or accounts list, if you like, whatever you want to call it. But it's just, instead of just calling numbers all over the place, we tend to try and group them together, because then it makes it easy for us to recall, what is this, an asset? It must be a one account. It must be in the 1s to 199. So there's our 5 that we talked about there. But then we often separate out these bottom 3. We separate cost of goods sold. Now, cost of goods sold is actually a subset of expenses. But we pull it out because it helps us create a thing called a gross profit. And a gross profit is one of those very, very important key indicators that we need to manage in our business. So it is an expense, but it's a special type of expense which we like to pull out and treat in its own. Same as extraordinary profit and extraordinary cost, because you don't want to be producing financial reports that say, well, we've made all this money. You could have just sold an asset for a really good price. You're actually trading business is no good at all. You know, your actual trading is going backwards, but you sold a tree because someone wanted it for $100,000. That actually is not a reflection of your business. That was just a lucky break. So we call that an extraordinary profit. We take it out of the business reporting because it just distorts our story. So same with the cost. You might have this year had a legal bill because you got sued over someone tripping over your Christmas tree. It's only going to happen this year. It's not going to happen in future years. So rather than make this year look terrible, we put that out and say, well, in terms of our trading, we did very well this year. It's just that we got that tax bill. So you take that out afterwards, you know. That's how you would go when you went to a loan. Otherwise, your bank would say, well, you made a loss. And so we take that out to just make it easier to be able to do that. So to ease our computerization and to set up industry standards, you can name these however you like. It's up to you, but generally this is the format we cover. Then it leads to an accounting equation. Accounting equation is sort of like, a bit like, and we'll do this in the exercise, that if you've got an asset, a house, most of us, house at $500,000. If you have a mortgage of $300,000, then your equity is $200,000, isn't it? The amount that you own in that house is $200,000. So you've got an asset. How much is your house worth, mate? $500,000. Yeah, but what's your mortgage? $300,000. So how much do you own? $200,000. That's all that means. That, what I've explained to you there, is actually the accounting equation and is actually the balance sheet of a business. How much is your business worth? Oh, it's worth, you know, how much has it been? $1 million. Yeah, but how much you got to pay people? Oh, $500,000. So how much have you really got owned by the owners? Oh, only $500,000. So that same analogy with the house is exactly the same analogy for a business, for a balance sheet, which is exactly the same for the accounting equation. This guy again, we already know. I just wanted to introduce you to the fact that the double entry bookkeeping is simply a system of recording transactions into a financial system that allows us to get these reports. And one of the keys to it is that every transaction affects 2 accounts. And it affects one account as a debit and the other account as a credit. That's all you need to know for tonight, because the rest of it, you'll just do your head in. I just want you to know, I just want you to introduce, you shake hands and you never ask them any questions ever again. Otherwise you'll die like me, wondering why did you come up with that? So who should keep their book? You can have the accountant keep your books. Accountants don't actually like it. You say, I'll bring all the receipts in and you'll keep my books. The accountant hates it because there's no value add. The accountant knows that he can't charge you, or she can't charge you the amount that she should charge you, because it's expensive for them to do, but you're not prepared to pay for it. They don't want to do it. They really want to just, if you're going to use an accountant, use them for compliance stuff, which is the tax, ASIC, and your funding. That's the big end. You want them at the big end of town, not at doing the trivial stuff. You can use a bookkeeper. They're cheaper than an accountant, but it still needs your time. And I've found that good bookkeepers will spend most of their time talking to you about how to put every transaction in. You know, what was this transaction? Is this your money or is it a sale? So you end up spending as much time talking to the bookkeeper as what you would do is if you were keeping your own books. Also, it's their business. they're making money. If I'm advising bookkeepers, I'm saying whatever you do, make sure that you really put every business on your system, because otherwise you'll get screwed with all this customization. So actually having a bookkeeper keep your books is actually giving into their system, and that mightn't be good for you. Also, they can't spot the mistakes. As I said, $10,000 went in as sales instead of going in as revenue. You wouldn't, I mean, going in as investment. You wouldn't have made that mistake, but they did, because they didn't take the time. They were busy. You know, they're only getting paid $33 for this hour, so boy, they won't get to spend much time figuring that out. Big consequences for you, though. MYOB, MYOB, Australian company, 10 years ago came up with a computer system that is just absolutely fantastic. It's growing amazingly. They can actually read your bank statements and turn your bank statements into Okay, so financial statements. As a student, you can get MYOB for $10. There you go. I think even they let you download it for free at the moment, but it has a run out period. There's free version, which is just all you need, and you can do it. Probably best to wait until I take you through how you would do it, and then download it from there. And I think there's a download, yeah. So they do it for free. I think it's $380 or something for the full version. So it's not a lot of money to pay. You'd be paying that in 10 hours of bookkeeping anyway.
Is that a yearly price, or is that just...
No, and they've got a new version. I haven't checked it out yet, but they've got one that actually scans in your bank statement, brings your bank statement across, and has a guess at what each of the transactions are. Because it sees Ray White, and you've told it that Ray White is red, and you've told it that Bidvest is cost of goods sold, and it actually does that for you. And then says, these are the ones I don't know what they are. And then you just go in and code that. So there's a lot of really good stuff happening there, which means we should be doing it, guys. Okay, financial statements. This is remember the output. Outputs are financial statements, and I want to get you half an hour on this thing. Financial statements help managers make decisions, and they help businesses comply with the law. There's two that we need to know about. Balance sheet. Balance sheet is basically a snapshot of your business at a particular point in time. If we were to take a snapshot, we would say, what assets do we have? What money do we owe to outside people? And therefore, how much money do the owners own? How much of the business is owned by the owners? So it's a snapshot of your financial strength, because obviously the more equity you have in a business, ask these bankers, the more equity you have in the business, the stronger your business is. If you've got a business with plenty of equity, in other words, that most of your business is owned by you, then that's a very strong business. So the formula is the assets equals the liabilities, money owed to outside people, plus the owner's equity, which is money owed from the business to the owners. The other one is an income statement. There's a lot of AKAs in this because this is today called the Statement of Financial Position. This one is called the Statement of Financial Performance. That's just another name change that's happened a few years ago. Most of us still refer to it as the balance sheet and the income statement. The income statement deals with the past period, and it talks about your financial sustainability. So while one is a snapshot at a point in time, the other one is a look at the last 6 months, 12 months, usually, of your business, just to look at your revenue, look at your expenses, and see if you're sustainable. And see if you're generating a return on investment that is going to keep the owners interested in investing in that business.
What's profit and loss then?
Same. Same name. Same name as a profit and loss is exactly the same as an income statement. So they're the same animals. You'll need to get my report and download it. Okay, just quickly. So balance sheet. Every financial transaction changes the balance sheet. You know, at this point here, if something happens, your balance sheet changes. And under the MyOb system, that used to take a whole month before it was recognised under the manual bookkeeping system. Under the computerised system, when you put an entry into the start point, your balance sheet immediately gets updated. That's the beauty of computerisation, is your balance sheet is constantly up to date, whereas it used to take a month to make that change. The balance sheet is just a representation of the accounting equation, that the assets are basically, the claims over the assets are either the people, external parties, or internal parties. That's all that actually means. The owner's equity is another way of saying it. If we took all of our assets and we sold them off for cash and we paid off everyone that we owed money to, what would we have left over? That's what owner's equity is. Owner's equity is the amount that would be left over after paying off all of our liabilities from the sale of our assets. Yes, David?
If you put, like, in the computer, like, your assets, if you say, like, fixtures and stuff like that, does it change with, like, time? Do you know what I mean? Like, obviously, when you go to resell the fixtures and stuff, it's not going to be as worth as much as what you paid for it. Is that...
Yeah. The government allows in your tax return to depreciate your assets, which is a really wonderful expense to claim, because you don't actually pay, all expenses, you actually have to pay something to get the benefit. With depreciation, the government just lets you depreciate your assets. So you get a tax deduction without actually spending any money. So it says you've got $10,000 worth of, here, this room, chairs and tables. We will let you depreciate that at 10% a year. So we're going to take $1,000 and write it off our tax. Well, that's $1,000 we don't have to pay tax on because our assets have depreciated. So yeah, that's called depreciation. And the government allows us, there are set rates. You can't just say, oh, the assets have been written off this year. They actually have set rates, 8 years for carpets and 5 years for some things. Computers get 3 years, so that's pretty good. So there are set tax rates, and your accountant will know all about that. Owner's equity is also called net worth, and that's another way of saying, what's your net worth? Your net worth is, well, yeah, sure, you've got $1 million business, but what would happen if you had to pay off all your liabilities? Oh, my net worth is really only $500,000, whatever. The current earnings that appear on your balance sheet are actually, the current earnings is actually the net profit from your income statement. So the final result of your income statement, that number actually goes straight across to the balance sheet and sits inside owner's equity. Because remember, the profit from a business is owed to the owners. So it sits over there as a owner's equity. There's a lot we've covered tonight. Current and non-current. Sometimes you'll see a balance sheet that says current assets and non-current assets. Accountants are very creative people. They said, we'll call it current asset. What do we call the other group? Oh, no, we'll call it non-current. I always thought that was quite creative, wasn't it? No. So non-current just means greater than 12 months. It's a current liability if it's due within the next 12 months. If it's due greater than 12 months' time, then it's non-current. If it's an asset that can be converted into cash within 12 months, it's likely to be a current asset. If it's an asset that has you plan to keep, or it can't be converted easily into cash, and it's something you plan to keep for longer than 12 months, then it would be classified as non-current. Okay, income statement, and we finish here. Income statement is the expansion of that one line that's on the balance sheet that says current income. It actually comes out, that one line comes out and gets blown up to include the revenue that you've earned less the expenses to come up with that number. And it provides key information to compare comparison benchmarks and forecasting. So out of the profit and loss statement, we get valuable data like the gross profit percentage, which doesn't mean anything to you tonight, but it will when you start doing forecasting. Variable costs, again, we'll learn about